Looking at the latest news on Opendoor Technologies Incorporated, ticker symbol OPEN, are we looking at a falling trend flashing massive sell signals or, a strong buy that is simply wildly undervalued right now?
I mean, it is the ultimate market tug of war right now.
Yeah.
And depending on which metric you prioritize, well, you can build an incredibly convincing argument for either side.
Yeah, before we unpack this puzzle, please hit that like button, subscribe to our YouTube channel, and it is absolutely compulsory that you leave your thoughts and feedback in the comments down below.
You read all of them.
We really do. Welcome to today's deep dive. Today is Thursday, April 16th, 2026, and our mission is to act as your guide through, frankly, an absolute mountain of conflicting financial data.
Not to mention the technical analysis.
Right, and some truly wild insider trading reports regarding Opendoor stock. If you've been watching your portfolio this week and wondering what on earth is happening with this ticker, well, we are looking at the raw data right now to separate the signal from the noise.
And I need to explicitly state the ground rules before we get into the heavy numbers. This is an educational debate. We are exploring the underlying data, the math, and the market psychology driving these moves.
Exactly.
But we are absolutely not providing any financial advice.
We are decoding the puzzle, not telling you how to play the game. So to figure out if Open is a value trap or a hidden gem, we first have to understand the sheer whiplash of its recent market performance.
Oh, yeah.
This stock has been on a truly historic roller coaster.
It really has. Let's look at where the price is sitting today, just to, ground the conversation. Following a very bullish short-term rebound of 6.87% yesterday, April 15th, the stock is currently trading at $4.82.
Which caps off a 4-day winning streak. Like, if you are just glancing at your phone this week, you are seeing a wall of green.
Right.
You're seeing aggressive momentum.
Well, you are seeing a localized burst of momentum, but we have to zoom out to see the overpushing narrative here. The long-term trend remains undeniably bearish. Even sitting at $4.82 big cents today, this stock is still 55% below its 52-week high of $10.87.
Which is a massive haircut for anyone who bought the top.
Oh, absolutely.
But then you look at the other extreme. The 52-week low for Opendoor was a staggering 51 cents.
Yeah, that was a dark time for them.
I mean, we are talking about a stock that went from looking like it was going to be delisted and face bankruptcy at 51 cents, rocketing up to almost $11, and is now hovering right in the middle around $4.80.
It's wild.
This level of volatility scrambles a trader's brain. So is this 4-day winning streak a genuine recovery of the fundamental business? Or is this just, a classic dead cat bounce within a much larger punishing downward channel?
Answering that requires us to completely ignore the price tag for a moment and look under the hood of the business itself.
Okay, let's do it.
The stock's volatile price action is merely a symptom of a massive structural earthquake happening inside the company's financials.
The engine is definitely making some strange noises, I'll say that. We need to figure out if it's stalling out completely or just changing gears.
Right.
Let's look at the annual income statement for 2025,
Yeah.
because the top-line numbers are incredibly rough.
Rough is an understatement. We are talking about a profound contraction. Total revenue plummeted to $4.37 billion.
Wow.
And in isolation, $4 billion sounds like a healthy company, but you have to compare it to 2024, where they brought in $6.95 billion.
Right. So we are looking at a revenue drop of over $2.5 billion in a single year.
Exactly. And the bottom line is bleeding out just as fast.
Yeah. Net income for the trailing 12 months sits at a painful $1.3 billion loss.
A huge loss.
And the earnings per share over that same trailing 12-month period is negative $1.70.
So you have a top line that is shrinking violently and a bottom line that is hemorrhaging over $1 billion.
Yeah.
Typically, when you see a combination like that, the balance sheet looks like a graveyard. But let's look at Opendoor's Q1 2025 balance sheet. It defies those expectations entirely.
It really does. They have total assets of $2.41 billion against total liabilities of $1.4 billion.
So they are sitting on a solid billion-dollar asset cushion.
Exactly.
And here is the metric that completely threw me for a loop. Their cash flow for the trailing 12 months is overwhelmingly positive.
It is.
Operating cash flow is positive $1.05 billion. Free cash flow is positive $1.04 billion.
This is the core anomaly of Opendoor right now.
Wait, let's slow down and let this breathe for a second, because this feels like, accounting magic. How can a company post a negative $1.3 billion net income losing money hand over fist on paper, but simultaneously boast a positive billion-dollar free cash flow?
It's a great question.
It reminds me of a massive factory that builds cars. Imagine a legacy automaker decides it doesn't want to build physical cars anymore. It only wants to design the software for self-driving vehicles.
Okay, I follow you.
To make that pivot, they sell off all their massive stamping presses, the robotics, the warehouses, the steel inventory. They liquidate everything.
Right. For the next 12 months, their cash flow looks incredible because they are depositing billions of dollars from selling their old equipment. But their core business, actually selling cars, has stopped. So their operational net income is deeply negative.
That's a really good way to look at it.
They are flush with cash, but operating a totally unproven new business model. Is that the kind of dynamic happening here?
That factory analogy perfectly illustrates the mechanics at play. Opendoor is not running a highly profitable, sustainable operation right now. They are executing a brutal, high-stakes strategic pivot.
Right, from their old model.
Exactly. Under their original business model, they were an iBuyer. They bought massive amounts of physical real estate directly from homeowners, held those homes on their own balance sheet, and tried to flip them.
Which works beautifully when interest rates are low and housing prices only go up.
Sure.
But when mortgage rates spike and housing freezes, you are suddenly holding billions of dollars of depreciating assets.
Which is exactly why the stock hit 51 cents a year ago. The market thought the carrying costs of those physical homes would bankrupt them.
Right.
So Opendoor made the decision to pivot to a capital-light, AI-driven technology platform. Instead of buying the house and holding the risk, they simply want their software to connect the buyer and the seller, acting as a highly efficient algorithmic marketplace.
Interesting.
They take a fee, but they don't hold the bag.
But to get to that capital-light future, they have to unwind the massive real estate inventory they acquired under the old model.
Exactly.
Where they're dumping the physical houses.
And when you sell off billions of dollars in homes, you generate massive positive cash flow. That explains the positive $1.04 billion in free cash flow.
Okay, that makes sense.
But because the broader housing market has been under immense pressure, they're often selling those legacy homes at a loss, or at least absorbing massive operational costs to clear the books.
So that explains the $1.3 billion net loss.
You got it. The positive cash flow is transition money. It is the runway they are buying themselves to figure out if their new software platform can actually generate sustainable revenue.
Okay, but if the revenue is tanking during this inventory dump and the new software model is entirely unproven in a high-rate environment, logic dictates that the executives inside the company should be terrified.
You would think so.
You would expect to see the classic signs of rats fleeing a sinking ship. But the people actually steering Opendoor are doubling down in a way that is almost hard to comprehend.
The insider activity over the last 12 months tells a completely different story than the income statement. We have seen 16 different corporate insiders at Opendoor making open market purchases.
I want to focus on the scale of this because they didn't just buy a few token shares to appease shareholders and project confidence.
Not at all.
Over the last year, insiders bought an aggregate $1.69 billion worth of stock.
It's massive.
Meanwhile, insider sales over that same period were roughly $3.58 million, almost $1.7 billion in buying versus less than $4 million in selling.
That ratio is staggering. It represents a level of conviction from the C-suite and the board that you very rarely see in a company posting billion-dollar trailing losses.
I have to push back on this, though, because insiders are human, and humans can be trapped in an echo chamber of their own hubris.
That's a fair point.
Could this just be a massive miscalculation by executives who are too close to the project? Because when you look across the street at the professional analysts whose entire job is to strip away the emotional bias and value the company objectively well, they strongly disagree with these insiders.
You really do.
The consensus on Wall Street is a hold. Out of 10 analysts covering Opendoor, we have 1 buy, 5 holds, and 4 sells.
The divergence becomes even more apparent when you look at their actual price targets. The median Wall Street estimate for the stock is sitting at just $1.76.
Which is drastically lower than the current $4.82 trading price.
Way lower.
Even the most optimistic analyst in that group only projects a target of $4.33, which still implies the stock is currently overpriced. If the quantitative analysts are modeling a drop down to $1.76, what do the insiders see that justifies pouring $1.7 billion of their own capital into this ticker?
You are looking at a fundamental clash of timelines and incentives.
How do you mean?
Well, an equity analyst at a major bank is typically modeling for the next 12 to 18 months. Their discounted cash flow models heavily weight the current realities. Falling revenue, negative profit margins, and a macroeconomic environment where high mortgage rates have frozen housing mobility.
Right.
When an analyst plugs those metrics into a spreadsheet, it spits out a $1.76 valuation. They are penalizing the stock for the immediate, messy reality of the pivot.
So the analysts are judging the factory while it's still covered in dust from ripping out the old equipment.
Exactly. Insiders operate on a 3 to 5 year horizon, especially when deploying that scale of capital. They aren't trading the next quarter's earnings report.
That makes sense.
They are looking at that positive billion-dollar cash runway and betting that they have survived the existential threat of their old inventory. They believe the proprietary AI matching engine they're building will scale with software-like margins once the housing market thaws.
Which creates a valuation that Wall Street simply cannot model yet because the business type is unprecedented in this sector.
Precisely.
But with the analysts modeling a collapse to under $2 and the insiders betting billions on a massive tech multiple expansion, retail investors are caught in the crossfire.
They are.
To figure out who is actually winning the argument today, we have to strip away the opinions and look at the cold math of the technical charts. We need to see where the trading momentum is flowing right now.
Well, the charts reflect a stock caught in a violent squeeze between short-term optimism and long-term pessimism.
Yeah.
At $4.82, the price is currently sitting above its short-term moving average, which hovers around $4.50.
Okay.
This confirms that the immediate multi-day trend is upward.
But the shadow looming over that is the 200-day simple moving average, which is sitting way up at $5.49.
Yeah, that's a big hurdle.
For anyone heavily tracking momentum, the 200-day average is the ultimate lie detector test. If a stock is trading below it, the macro trend is still dictating a bear market for that asset.
And the momentum indicators beneath the price action explain the anxiety traders are feeling.
Right.
The Relative Strength Index, or RSI, over a 14-day period is currently at 39.1.
It's lingering in that neutral zone, but creeping toward oversold territory. It suggests the aggressive selling pressure that drove it down from $11 might be exhausting itself, but buyers haven't fully committed to taking control yet.
We see that hesitation perfectly mirrored in the MACD, the moving average convergence divergence indicator. It is currently sitting at negative 0.19.
Okay.
The mechanics of the MACD right now are generating highly conflicting signals across different trading desks.
Unpack that a bit for us. Why is the MACD causing so much confusion?
Well, the MACD measures the relationship between two different moving averages of a stock's price to gauge momentum shifts. Recently, the MACD line crossed over the signal line, which algorithmic trading platforms often immediately flag as a buy signal.
Right.
But because that crossover happened while the overall MACD value is still in negative territory, conservative fundamental traders look at the exact same chart and see a temporary blip inside an ongoing bearish trend.
So the algorithms see a spark, but the human traders look at the negative baseline and think the wood is too wet to catch fire.
Exactly.
This translates to very specific battleground levels on the chart. Key support right now is sitting at $4.78 with a harder floor at $4.70.
But they really need to hold.
Yeah, if it breaks below $4.70, the floor falls out, and we likely revisit the analyst's bleak targets. On the upside, resistance is parked at $4.88 with a massive psychological ceiling at $5.
That $5 mark is critical. For a stock that was once trading at 51 cents, breaking and holding above $5 requires an immense amount of sustained buying volume.
Right.
Looking at recent order flow, we saw swing traders act on that technical buy signal around April 14th when the stock dipped to $4.37. But the options market is telling a slightly different story.
It is. Options flow shows moderate bearishness, down about 5.39%.
Yeah.
Options traders are currently paying a premium for downside protection, suggesting they don't fully trust this 4-day winning streak.
This brings us to the core psychological trap of this deep dive. Is Opendoor a value trap, or is it a genuinely undervalued tech play?
That's the million-dollar question.
You have this terrifying negative 29.74% profit margin that screams, stay away. But the bulls look at a stock that fell from nearly $11 down to $4.82 and think the risk has already been entirely priced in.
Right. But that assumption is precisely how retail investors get decimated in a value trap. You open your brokerage app, pull up a one-year chart, and you see that $10.87 peak.
Exactly.
Your brain instinctively anchors to that number as the true value of the company. When you see it trading at $4.82 today, your immediate cognitive bias tells you it is effectively trading at a 55% discount.
It feels like walking into a store and seeing a designer jacket on the clearance rack.
Yeah,
You assume it's a steal simply because the original price tag was higher,
exactly.
but a stock that is down 55% is not automatically a bargain. A true value trap occurs when a stock appears cheap based on its historical price action, but is actually priced correctly or might even still be overpriced because the fundamental mechanics of the business have structurally degraded.
Yeah.
If the new capital light software platform fails to generate high margin revenue, then Opendoor at $4.82 isn't a discount. It's a company still slowly bleeding out its cash reserves.
And retail traders often jump in based purely on the discounted visual of the chart, entirely ignoring the mixed MACD signals and the brutal macroeconomic headwinds.
Those macroeconomic headwinds dictate the risk profile here, and we really need to map out the best and worst case scenarios.
Let's do it. Let's talk about the metric that defines Opendoor's volatility. It's beta. The data shows this stock has a massive beta of 3.78.
Right. And beta is the measure of a stock's volatility in relation to the overall market. If a stock has a beta of 1, it moves roughly in tandem with the S&P 500.
Right.
A beta of 3.78 means Opendoor is essentially a highly leveraged play on market sentiment. It is almost 4 times more volatile than the baseline market.
Which means if the broader market experiences a mild correction, Opendoor experiences a violent sell-off.
Exactly.
If the market rallies, Opendoor explodes upward. It acts as a massive amplifier. And right now, that 3.78 beta makes the stock hypersensitive to the most important metric in real estate, mortgage rates.
Let's construct the bear case using that sensitivity. In the worst-case continuation scenario, inflation remains sticky and the Federal Reserve is forced to keep interest rates elevated.
Which we're kind of seeing.
Right. Mortgage rates stay high, meaning the housing market remains completely frozen.
Yeah.
Homeowners refuse to give up their legacy 3% mortgages, so inventory stays incredibly tight and buyers are priced out.
A total gridlock.
In this environment, Opendoor's revenue continues to freefall. The new AI platform struggles to gain traction because transaction volume across the entire country is just dead.
Wow.
They burned through that $1 billion cash cushion trying to keep the lights on. The bearish options traders are proven right, and the stock slides inexorably toward that $1.76 time-list price target.
So the short-term technicals break down, and the macro environment crushes the micro execution. But let's flip the board and look at the bull case.
Let's hear it.
The best-case recovery scenario relies heavily on that $1.69 billion in insider buying being the ultimate leading indicator.
Yeah, in the bull case, the executives were right. The transition to the capital-light marketplace works beautifully. By shedding the massive physical inventory, they eliminate the immense holding costs that almost bankrupted them a year ago.
Right.
They use that $1.3 billion in total cash to aggressively market and refine their software just as macroeconomic pressures begin to ease.
Mortgage rates finally tick downward, unfreezing the housing market.
Exactly. Transaction volume spikes. Because Opendoor is now acting as a high-margin toll booth rather than holding the actual assets, their bottom line explodes into profitability.
And then the analysts are forced to completely rewrite their valuation models to treat Opendoor like a tech company rather than a real estate flipper.
You got it. And the stock rapidly reclaims its 52-week highs.
So, to summarize, the short-term outlook is a technical minefield of conflicting momentum indicators. The long-term outlook depends almost entirely on the success of this unproven marketplace model and a broader housing recovery.
Yeah, that's it in a nutshell.
Looking at all the data we've analyzed today, the dynamic reminds me of a high-speed speedboat. That speedboat is Opendoor. It represents that massive beta of 3.78.
I like this analogy.
It's wildly volatile, it's capable of incredible acceleration, and the insiders just dropped $1 billion to outfit it with a brand new AI engine.
It has all the internal mechanics for explosive growth.
But the speedboat is securely tethered to a massive, incredibly slow-moving cruise ship. And that cruise ship represents the macroeconomic housing market and traditional mortgage rates. It doesn't matter how advanced the boat's new software engine is or how much conviction the CEO has steering the wheel, it simply cannot outrun the cruise ship it is tied to.
It's trapped.
Exactly. If the overall housing market remains anchored in place by high rates, the speedboat is just going to burn through its fuel doing donuts in the water.
That perfectly captures the tension here. The macro environment acts as an absolute immovable ceiling on the micro execution of the company.
It really does.
Until the structural drag of mortgage rates eases, Opendoor's new platform is fighting an uphill battle against gravity, regardless of how elegant their AI matching technology might be.
Bringing all of these threads together, this deep dive reveals a company standing at a profound crossroads. On one hand, you have terrifying trailing financials, a $2.5 billion drop in revenue and a $1.3 billion net loss.
Brutal numbers.
On the other hand, you have massively optimistic insider buying to the tune of $1.7 billion, fueled by a positive cash flow anomaly generated by liquidating their past mistakes.
The ultimate takeaway here is the sheer density of the uncertainty. The Wall Street analysts issuing sell targets are projecting the past into the future.
Right.
The insiders buying shares are projecting a flawless execution of an entirely new business model. The truth is, nobody, not the algorithmic models reading the MACD crossovers, and quite possibly not even the insiders themselves, knows for absolute certain if this capital-light pivot will actually save the company when the dust settles.
Which leaves us with one final provocative thought for you to ponder as you look at your own portfolio. We talked about the speedboat tethered to the cruise ship.
Right.
But what if the ultimate goal of Opendoor's new technology platform is to figure out how to cut the rope entirely? If they successfully transition into being the underlying software infrastructure for real estate transactions, taking a fee without holding the physical asset, will their stock price finally break free from the gravity of traditional mortgage rates?
That's a fascinating thought.
Or is real estate simply too physical, too emotional, and too capital intensive of an asset to ever truly be capital light? Can you really softwareize the American dream of owning a home? Or will the physical reality of the housing market always drag this stock back down to earth?
It's definitely something to think about.
We want to know what you think. Head down to the comments and let us know if you are riding with the billion-dollar insider conviction, or if you think the Wall Street analysts are right to call this a falling knife. Thank you so much for joining us on this deep dive. Keep questioning the data, and we'll see you next time.